Thank you for joining the R.O.Hammer Company's podcast. For all you real estate investors, in today's episode, I was joined by 1031 exchange expert Jeff Peterson. Jeff is an attorney and also the president of CPEC 1031. Jeff's also known as the professor of 1031 exchanges. I hope you enjoyed the episode. Hi, Jeff. Thanks for joining. I appreciate you making the time.
John, it's great to be here. Thank you for having me.
Yes, of course. I'm excited to ask some questions and learn. Let's start. Can you tell us a little bit about yourself, your background, where you're from, that type of thing?
Sure. I'm from the Twin Cities in Minneapolis, and I've been operating a company called CPEC 1031. We've been in business since 1998 in downtown Minneapolis. We're on the 40th floor of the 222 building with gorgeous views of the Minneapolis skyline.
Very nice.
And, all we do is facilitate 1031 exchanges. So we are in the trenches, humbly administering exchanges day in and day out, which gives us real authenticity and real credibility because we really know what we're doing. We have an extensive amount of experience, and we try to be very cooperative for assisting, to facilitate the success of our clients' exchanges. So we have a saying that if we see something, we say something. We don't let you drive off the rails without saying, hey, there's a rail right here. Try to stay in the middle of the fairway whenever possible.
Excellent. So you received your BA and JD from the U of M.
That's correct, Minnesota.
I've been a previous client of your company, so we'll speak about that. But you want to tell us just a little bit about your educational experiences and how that journey kind of led you down the real estate law and tax planning route?
Interestingly, my undergraduate is in speech communications, and right out of college I worked for a television channel that's in downtown Minneapolis on the Nicollet Mall. So that was kind of my gig as I was going into broadcast journalism, and then decided I wanted to go to law school, and I loved the study of law. I loved it so much. And I like being a problem solver, and I like helping people. So it was fun to find a career where I don't have to be incredibly litigious and aggressive. I'm a problem solver. 99% of my clients are going to be very happy because they like the result that they're getting, which is they're deferring a lot of taxes and keeping a lot of their hard-earned money working for them. So it's a really wonderful way to serve the community and to be able to provide for my family, to be quite honest.
I guess it'd probably be a good idea. Both of us know what 1031s are, but for those our guests who don't, can you just give us kind of a high-level explanation of what a 1031 exchange is?
It's interesting because for my almost entire adult life, I've worked in one little code section in the Internal Revenue Code, Section 1031, and it allows you to defer your taxes. So you're not putting them out of commission, you're just putting them on the back burner until such later date as you recognize the gain. So you're just deferring your taxes. And it's for the sale of real estate that's been held for investment or business purposes when you're going to be acquiring new real estate that's also going to be held for investment or business purposes. So 1031 is an incredible, powerful tool for helping people compound and build their wealth in the realm of real estate.
Yes.
Imagine how much wealth you could amass if you could go through life without ever having to have the recognition of gain. You get to keep that money rolling forward. And the other thing about real estate that's so marvelous is the use of OPM, other people's money, to lever up and borrow against and increase your buying power. So you can have a lot of real estate under your control if you start early and you build that wealth and then you leverage it against the debt, and then there's something called inflation that occurs. Even if you're the worst operator in the world, your properties are probably going to appear to go up in value as the currency declines in value against hard assets like real estate, because we continue to pump out and print dollars, diluting the existing currency that's already out there.
Yes. I'd also add on top of that, I do a fair amount of real estate investing. I've also bought 20-some businesses. Real estate is tangible. It's easy to collateralize. It's safe investment.
You can kick the tires.
Yes, and then on top of the other positive things about it, you also have depreciation expense, which is very nice. Yeah, it's a great investment vehicle. I agree. So again, for those who don't know about the 1031 exchange, it is not forgiving tax. It is delaying tax. Any other kind of common misconceptions that about the code that you'd mention?
Well, I think that there's two areas where you can't do a 1031 exchange. There's the personal use property, like if you have a lake cabin in Amory, Wisconsin, that you've only used for personal use, jet skiing, barbecuing, and so forth, that's probably not going to fit in the strike zone for being held for investment or business purposes. In fact, there's a case called Moore v. Commissioner where the IRS just totally obliterated a client or a person that was trying to do a lake home for a lake home exchange. The taxpayer's argument was that lakeshore property was a scarce commodity, and so they thought it would go up in value. But their use of the property was all barbecuing and having fun and using for personal recreational use. Their use trumped their purported investment intent. And then the other area where you can't do a 1031 is inventory. If you peddle real estate to the public, like let's say you bought a piece of 40-acre tract and you cut it up into little residential lots, filed a plat, and started selling those lots to the public, the real estate at some point isn't an investment, it's your inventory. You're just basically repackaging and selling it. So house flippers fall into this category. They're not buying for investment, they're buying for resale.
Yes, and correct me if I'm wrong, is there a real estate professional qualification, like once you pass a certain...
It's really a facts and circumstances analysis, and you couldn't have murkier waters for what is dealer property, particularly if you are a dealer, but maybe you own other real estate that's maybe held for longer term, and maybe it's all mixed in an LLC because you don't know when you buy something whether you're going to want to hold it long term or sell it quickly.
Sure. And we're going just high level for people who are new to this too. Can you explain capital gains and tax implications based on the length of holding as well?
Well, when you do a 1031 exchange, your basis is augmented. Your basis in the new property is reduced by the amount of deferred gains that you didn't have to pay. And because of that, you always get long-term capital gains treatment as long as you had at least long-term on your old property. So you carry that long-term capital gains treatment with you to the next property. Even if you sold your replacement property 2 days after acquisition, you don't count the mere period that the replacement property was owned. You get to tack the period of time that your predecessor property was held. But generally speaking, in the U.S., you've got capital gains broken into long-term capital gains, which is after a year or more of holding, after it's been put into service. And then you've got short-term capital gains, which is not really that good. It's kind of the equivalent to earned income. You get crushed with taxes. So, gosh, I feel terrible for the flipper. They don't get to do 1031s. They don't probably hold long enough. Well, maybe I don't know. Geez, I don't know how that's going to pan out for them, but it's not going to be good. They're going to have a lot of taxes to pay.
Yes. I have seen a couple instances, thinking back now, where, as you mentioned, investors started very early, continued to roll through 1031s. Throughout the course of his career, and then had properties that were generating income even in retirement, and then passed away. Benefactors or beneficiaries of his estate, the cost basis is reset, correct?
That is like the coolest thing about this whole plan. But in order for it to work, John, you got to die. And maybe that's a side hustle that you and I could start, is the accelerated step up for your pesky elderly relatives that are holding appreciated real estate. That's a joke, people, just to let you know. All right. So the step up in basis is basically defer. Throughout John's entire life, he never unnecessarily recognizes gains, but when John dies and his heirs inherit property, which is his properties, under Section 1014, they don't take the basis with low John basis. They take fair market value basis, which means they could sell the properties the day after his funeral and have no gain because their basis is what the current fair market value is. That's too good to be true.
Yes.
Oh, that means you restart depreciation again too. So if you want to continue to hold, now you can hold and you have more efficient yield because your after tax cash flow is better because of the step up.
Yes. And anytime you identify tax code that appears too good to be true, there is the potential for some political capital, low-hanging fruit. I know that you've been doing this, I believe, since like 1998. Has there been, since you've been practicing, changes, or has the 1031 landscape evolved at all?
Well, they did try to do away with the step up in basis. I think it was 2010, 2011, somewhere around there. I can't remember exactly when that time period was. It has been in the code for a long time.
Yes.
In part because of convenience, because it's hard to figure out what someone's paid for a property years and years ago. So it's somewhat a convenience factor, but it's also maybe in light of the fact that we have a different tax regime called estate tax, where we can tax the value of someone's estate upon death. Steinbrenner was a wealthy guy that happened to, I think, die in 2010. He just kind of hit it wrong because for a brief period of time they had augmented the step up in basis. And so that's kind of an interesting little trivia piece. But long story short, it's in the code. I don't think it's going anywhere. And in the current political landscape, I think that things that are good for real estate, good for farmers, good for the transfer of wealth to the next generation are probably safe.
I would agree with that statement wholeheartedly. So I want to try and tap your knowledge a bit further now that we kind of have like I said, a high level understanding of what a 1031 exchange is. It's like kind property code. Let's talk a little bit about the different strategies. So you helped me previously with the reverse front leg 1031. There are a couple of other options too. Could you talk about the different ways to use this code, the different strategies?
Yeah, I mean, most of our people are just doing vanilla, easy peasy 1031s where you sell the relinquished property first and you acquire the replacement property within the 180-day period. You have to identify it. It's pretty easy. Know that you typically want to buy a replacement property of equal or greater value so that you have a continuity or continuation of investment into property or properties of equivalent or greater value. So if I sold a property for $10 million and I only bought a $1 million replacement, you'd be like scratching your head. I don't see a continuation of investment, Jeff. What's going on? The next thing that you typically do is you don't take any cash off the table. If you go back to like 100 years ago and read the congressional legislative history, the whole rationale for 1031 is they didn't want to slap you on the wrist if you weren't cashing out, if you were just continuing your investments. The next step is don't take any money. Don't take any cash. If you want to completely defer the gain, keep your hand out of the cookie jar and redeploy all of that equity or proceeds into the next property. So we've talked about value, we've talked about equity. And then the third element is the debt relief. When I pay off my old mortgage, it feels good to be able to stand up tall without having that debt on my back. But I got to brace myself because when I buy the replacement property, I either have to take out new purchase money debt, assume debt, or maybe if I win the Powerball lottery, I can bring cash to the table and offset the debt relief with new cash. But somehow I got to cover my debt relief, which typically means you're going back in and getting more debt. Otherwise, you wouldn't be able to buy at that value. All right, so that's the forward exchange, where you're buying a more expensive property typically, reinvesting all your cash. And that is the 45 days to identify, running concurrently with the 180-day exchange period. But there is a trap for the unwary, as you probably know, John, that the 180 days can be shortened to the due date for the filing of your federal income tax return. So if you started an exchange late in the year and you file April 15th or March 15th, you might not get your full 180 days. But there's an easy fix. Do you know the expression, the left hand and the right hand have to know what they're doing or have to work together? The accountant needs to be told, hey, file an extension, because otherwise they will dutifully file your tax return on time while you're still trying to wrap up your replacement acquisition, right? That could be a problem.
Yes, that is a key pitfall.
I want to talk about a couple other different variations of 1031s. One of them that I'm really excited about as a capitalist, as an entrepreneur, is the build-to-suit exchange. Let's say that you are a business owner and you have like a industrial operation in the heart of Minneapolis, but your neighborhood brick facility is too small for you now, and the trucks coming and going are bothering the neighbors, and the neighborhood has changed around you, and you're no longer really appreciated for what you do. Maybe you want to move your operations to a northwestern area like Rogers, Minnesota, or St. Michael or something like that, because the land is plentiful and the city zoning and governmental authorities are maybe more welcoming for your operation. They want the employees, they want the economic vitality that you bring. You're appreciated. So you say to yourself, all right, I'm going to do a build to suit exchange. I'm going to sell my relinquished property, I'm going to buy a piece of dirt in St. Michael, and I'm going to construct a new facility. And then I'm going to move my operation in. But hold on a second. Logistically, I can't sell my old location until I've got my new location, and I can't move my company and my equipment until the new one exists. So now we have to do what's called a reverse exchange, because we need to actually buy that land in St. Michael first, arrange for the construction and erection of these buildings so that we've got something to move into. So we're going to curate the existence of our replacement property and then sell the relinquished property. So that's a reverse exchange where we're parking the replacement property because it's a necessity. And now you can do this under the safe harbor, under RevProc 2037, but unfortunately you can only park the property with the intermediary for 180 days, which is woefully too little time to build the Taj Mahal if you're building enormous, replacement improvements. So the other way to skin it is that you go and do your exchange outside of the safe harbor, outside of RevProc 2037, sometimes referred to as an estate of Bartel kind of scenario. We do a lot of non-safe harbor reverse exchanges when improvements need to be really elaborate and take a long time to construct. If that's the case, you probably want to hold off on not selling your relinquished property. Slow your roll on the sale until you can see the replacement property is coming into existence. And when you think you're within 180 days of having replacement property of at least equivalent or greater value, then you sell. But if you sell too soon, you may not have enough creation of replacement property to satisfy your exchange, and you only got 180 days once that relinquished property sells. So you don't want to sell too soon. Otherwise, you could paint yourself into a corner.
Is there anything in the code that prevents you from selling your existing property to an independent third party and leasing the same property?
A lot of people will try to do a sale leaseback if they can. I think it depends on how strong of a seller's market it is and how patient the new buyer is going to be. And it can also depend on the buyer's financing. So all kinds of equations that need to be balanced there. I still wouldn't want to sell fee title too soon, because if my new property doesn't exist yet and I need a longer runway to construct it, I might not be doing myself any favors by closing too soon on the sale.
Yep.
And then there's another kind of reverse, maybe a third kind, and that's where you have an unsold relinquished property and you want the intermediary to come in and become your surrogate substitute purchaser. That is what is called by John as a front leg. We're doing the front leg property and parking that with the intermediary. Typically we'll have a deed from the owner of the property to the intermediary, conveying that indicia of title to the intermediary. And then you've got 180 days to find a real legit purchaser that we can offload this thing on. Now, from an accounting perspective, a front leg only works if you've got some cash that you can loan to the intermediary so that they can buy this stinker off of you, get it off your hands. And then we take that cash that you've loaned to the intermediary and we apply it as the down payment for the replacement property. So on paper, it looks like a forward exchange. You sold to the synthetic purchaser credits the exchange account gets sent over to the replacement, and your money appears to be coming from a 1031 exchange. In fact, it's coming from your pocket and just coming all the way around the horn to be applied towards the replacement purchase.
Yes, less common, I think, that one, and maybe you're the professional, you could speak to that.
These days, less common. Back in the day, 20 years ago, that was the preferred modality to do. It was viewed as being less risky, and the intermediary is buying the property that the client knows, is familiar with, rather than the devil we don't know from an unrelated third party.
What can I ask? What is the most unique, or do you have like one example that was very complex, like any of your favorite ones that you'd want to share?
Well, I will tell you, things get crazy when you're selling multiple relinquished properties, maybe trying to sell 5 properties and trying to roll it all into one big acquisition. But what happens when one of the relinquished properties falls out of bed, the buyer leaves you at the altar? Well, that's a great opportunity if you have the cash to finesse it to be a front leg reverse as to that unsold relinquished property, take care of that nuisance that way. So we see some hybrid exchanges that are part forward, part reverse.
Interesting.
And then we see situations where maybe we're parking a portion of a replacement property as a tenant in common, holding like 40% of it for a future acquisition. Meanwhile, 60% of it is being acquired from an ongoing 1031 to complete an ongoing exchange and get that done within the 180-day periods. You can have situations that are bifurcated, front and back leg, or forward and reverse.
What's the most amount of properties that you've done in one?
Oh gosh, I don't even know. Some of these big portfolio purchases of oil and gas or large numbers of CVS drugstores and things of that nature can be, in the hundreds of parcels, especially with oil and gas holdings up in the Dakotas and in other parts of the country where oil
Lots
and
of moving
gas is
parts
prevalent.
with that many properties. I'd like to hear some of your thoughts on some of the other kind of creative strategies related to tax deferment real estate. There's a couple of like obvious ones, and then I'd like to see if you have any more up your sleeve. But can we talk a little bit about like opportunity zones, Delaware statutory trusts, and 721 exchanges?
Well, right now we're waiting for Congress to do something with the qualified opportunity zone. Those are kind of in a limbo right now because they're not as fun as they used to be. Initially, you got like 15% of your deferred gain forgiven, and then it went down to 10%, and then it went away altogether. The qualified opportunity zone needs a revamp because who's going to do one right now if you're just deferring the taxes until the end of 2026? That's when it comes due.
I split my time between the Minneapolis-St. Paul area and Savannah, Georgia, both of which happen to have federal opportunity zones. Savannah, in particular, had a significant amount of investment in the historic district.
Mm-hmm.
Civil War era townhomes selling for multi-million dollars from third-party money. Investment. So I think that the government did achieve some of their goals, but yes, I agree. It could use a revamp for it to continue. It essentially is like it does have some 1031 or like the ability to roll or defer the gains into the future too, I believe, right?
John, I'd like to make a political pitch. There's a lot of cities like Minneapolis, San Francisco, Chicago, where we have an urban downtown core that is suffering from some trends. One trend is remote work.
Yes.
People are not needing office space like they needed it before. There is a social disruption that's occurring, and there's some other things at play that make downtown office really, really vulnerable right now. The building I'm in right now went back to the bank. A number of buildings in Minneapolis have gone back to the bank. Now, that means there isn't enough revenue from these buildings to cover the debt service.
Mm-hmm.
People are losing their investments. I think that if they were to do a QOZ that was targeted to urban core office buildings, like that pinpoint, you could have a revitalization of these buildings, whether they get turned into residential homes, torn down completely and re-envisioned for something completely different. But we need to have an infusion of capital. Otherwise, cities like Minneapolis are going to suffer immensely because they are dependent on property taxes. And guess what? Property values are not high when the buildings are all going back to the bank, right?
Yes, that is a problem. That's a great idea. I think if we're continuing down that, or speaking in that vein, I guess, some of the opportunity zone areas in the Twin Cities, Minneapolis, St. Paul area, I mean, the purpose of the opportunity zone is to spur investment in these areas, but they are less desirable for actual investment, which makes the pool of potential investors smaller. Something like you're talking about is a great idea. There probably would be people looking for the tax savings to park even institutional investment, I would guess. And that's the difference between the Minneapolis-St. Paul area and the opportunity zone in the historic district of Savannah. Is it's a highly sought after area anyways. So the math works. People want to be there. But that's a great idea. I like that. When are you announcing your mayoral campaign?
No, but I did put that on LinkedIn, and it got a lot of traffic. So I think there's other like-minded people. Hopefully, with Congress has so many balls in the air. I don't think they're even worried about the QOZ, to be quite honest.
Yeah.
I'm not even sure it's even that high on their priorities. I think there's other things like carried interest and no taxes on tips, no taxes on Social Security. Those are high priority items. I want to talk about a hybrid transaction where you are selling your land to a developer, and the developer has persuaded you to go in with them for part of the purchase price. So maybe they're going to give you $10 million for your property. You say, I want $5 million cash that I can do a 1031 exchange with. The other $5 million I'm willing to kick in and do what's called a 721 contribution, where you contribute property to that joint venture and you become a minority partner in their joint venture development company. Now, you got to be careful. I've had clients that have been audited on these. Their 1031, of course, was smooth as silk because that wouldn't have any problems. But it's the contribution of the property that can be difficult. You got to make sure that you don't actually receive the $5 million of cash and then turn around and give it to the developer. Instead, you want to have a deed where you contribute your property via deed and no receive any cash. You want to get your seat at the table, if you will, and the consideration is the transfer of an undivided 50% of the real estate. That's what you want. Got to be very careful when you're contributing property to a joint venture to make sure that you're actually contributing property and not selling the property for cash and then buying your seat at the table with the cash.
Yes. And this is similar to a mechanism, I believe it's referred to as an UPREIT, slightly different process, but
very similar because that uses a 721 contribution as well, but not always. Not all DSTs are going to have the Pokemon morphing evolution up into the UPREIT. You know, some of them are just going to stay as a DST, a small little static portfolio for 5-10 years, and then they're going to sell that real estate and you're going to do another 1031. And some people prefer that small static DST because they may eventually want to do another 1031, other real estate, whereas once you've ascended into the heavens of an UPREIT through a 721 contribution, now you're in an UPREIT partnership and you can't do a 1031 exchange once you're in a partnership. So you're in the Hotel California now. You have to stay there until you, I'll let you say it, die, right?
Yes.
You stay there till you die and you let your kids inherit those REIT shares, which is, by the way, not a bad thing to do, because if you want to make your children miserable, give them highly appreciated real estate that's very management intensive. Give them a rooming house, a boarding house, and see how they fare managing that thing.
Yes.
Because they're going to be miserable, and the children will bicker and they'll fight because one will dutifully try to manage it while the others are armchair quarterbacking and second-guessing them. It will cause acrimony. And you can say, oh, Jeff, that will never happen in our family. But I've worked with so many dysfunctional families that have had second-generation real estate, and it doesn't go well oftentimes. Better off letting the kids inherit the REIT shares. You know, Susie takes 10,000 REIT shares, Bobby takes 10,000 REIT shares. They're not conjoined together. If one wants to sell their REIT shares, let them sell them. The other can hold on to them and get the step up in basis and reset the depreciation schedule. It's beautiful.
Yeah, it's a bit cleaner for sure.
So,
do you know by any chance what percentage of exchanges are audited?
I don't think very many.
Yeah.
I actually think that the federal government is not as aggressive as the states. Some states like New York and California are really uber aggressive. Particularly California. They're erratic and they're aggressive. So they will get something they don't like and they will tear after it.
Why do you think that is?
They will stick to it. They're in desperate need of collection of revenue.
Okay.
Their state is spending money they don't have.
Interesting. Okay, that's too bad. So I know that you are involved with is it William Mitchell?
I have been an adjunct tax professor when it was called William Mitchell. Then they merged with Hamlin Law School and became Mitchell-Hamlin. They would have merged earlier if they would have called it Hamlin-Mitchell, but that sequence of names was evidently finally settled, and they called it Mitchell-Hamlin. And it's a great place to teach, and I love teaching. It's a great experience for me. I love to pass on my perspective about wealth building. I don't just talk about 1031. In fact, I'm pretty sure I never talk about 1031. When I'm teaching law, I try to stick to the fundamental concepts, the pillars of taxation, like what is gross income, what's a tax credit, how do you compute income tax, and what are strategies for not paying taxes.
How many, do you mind if I ask how many attorneys are in your current practice?
I'm the only one at my company. I've got a staff of about 10 people that are all very accomplished, very hardworking, don't require any management or supervisory. They are the real deal. They are just really good people that take pride in their work and they work hard.
I enjoyed working with your team. Goes without saying, but they were very competent. It was a very smooth process for me.
We're lucky to be able to be a boutique. We do a very niche business in an area where there isn't a lot of competition, and we're able to really, if you will, specialize. The fact that it's very repetitious allows us to get really good and hone our skills quickly. So it's a nice business to be in.
Setting aside all the things you just mentioned, what are the benefits, additional benefits, we'll call them, of working with a firm like yours? Because there are other options available.
Absolutely. And I have been pulled in to consult with people when exchanges have gone badly with other intermediary companies. And when I get pulled into these things, I say, all right, I want the bank records right off the bat. I need to see the bank records. I need to follow the money. And invariably, I pull their stuff, and they're putting all the money in one commingled account, which is not a good way to go, because money is fungible. How can you tell if this is Bobby's money or Susie's money? When money goes missing, which sometimes happens, unfortunately, in this industry, you never want to have your monies have been commingled with someone else's money. So the first thing that I do is I always safeguard and protect the client's money, which means we open a separate segregated bank escrow account for every client. And when the closing takes place, your monies get wired into that bank account where it sits under a qualified escrow deposit agreement, where the bank actually becomes more than just a depository. They have a fiduciary obligation as an escrow holder to not release those monies until they get your signature on a withdrawal request. And John, if you say to yourself, well, that's not good enough for me, I want more protections, I'll do a rider to the qualified escrow deposit agreement that requires them to do a verbal callback and ask you for a secret password that's only known to you, John, and to the bank, that's not even known to the qualified intermediary. Sure. So they'll call you up and say, we want to confirm these wiring instructions, make sure everything's copacetic, and then you need to give us the secret password. Do you know what the secret password is, John?
I do not.
It's Aardvark33 in this particular hypothetical. If you don't say Aardvark33, they're not sending the money.
All right.
It'll sit there forever.
Good to know. Good to know. I know that you're doing these exchanges outside of Minnesota, because I've done exchanges with you in other states. Nationwide, anywhere in the U.S.?
Yeah, I would say that we are pretty much nationwide.
Any advice that you'd give to someone considering doing their first 1031, on like front-end advice?
Gosh, I would say have a consultation with, if you don't want to use me, that's fine, but have a consultation with a really knowledgeable qualified intermediary early, and really talk to them about what are the logistical parts of this process, and study the requirements and know what you need to do. What hoops must you jump through? And then build your team, because it's not just the qualified intermediary that helps you. At the end of this process, somebody's got to report the exchange on the IRS Form 8824. So maybe you want to have your accountant or tax preparer involved. And maybe you need a lawyer. Maybe you need to break up an LLC and have a partnership division, or maybe you need to have trust documents revamped. I don't know. So build your team. That also could involve your financial planner. Like we were talking about the Delaware Statutory Trust, the DSTs. Not all financial planners provide those alternative real estate investments. Northwestern Mutual, whom I'm with, doesn't do DSTs. Thrivent doesn't do DSTs as far as I know. And others, I believe Edward Jones doesn't do it either. So don't quote me on that, but you'll just know that not every financial planner has these alternative investments. So if you have a financial planner that doesn't have the product or doesn't have the exposure to the entire universe of those products, you may have to work with other financial planners.
I think that's solid advice. I again, consulting with somebody who's experienced is 99.9% of the time probably going to save you time and money, especially if something goes wrong. I don't know why you would do it any other way, but again,
I would just want to say, if you fail to plan, what are you doing? You're planning to fail. You want to visualize the process, know the roadmap, and know what you're required to do at each juncture. If you know the roadmap, you know the procedural process, you're going to be so much further ahead. And locking up a replacement property early, that is like going to make your life so much less stressful. The last thing you want to do on day 44 or 43 is to be running around like a crazed chicken with your head cut off, trying to frantically figure out what to identify. Because that's when mistakes happen, And you may make a move that makes no sense from a business perspective, where the tax tail is starting to wag the dog on the decision making a little bit.
Yes, and I have seen that in several markets with sophisticated investors where you see buildings sell where the numbers just do not make any sense. And it has to be someone coming out of an exchange who just needs to park money somewhere that, something that will appreciate to avoid the taxes. We're getting close on time here, and again, I appreciate you joining. Anything exciting happening over at CPEC that you want to share?
Well, I do want to tell you, I've been involved in the Federation of Exchange Accommodators, which is our national trade association. I'm the former president of that organization, and I currently serve as the president of our PAC, our Political Action Committee, where we raise money to basically get influence with legislators on both ends of the aisle. We need to educate anyone that is going to be in a position of influencing tax, and that means the Ways and Means and other groups that are influential in that process. So if anyone's interested in politics and wants to talk to me about our Political Action Committee or ways that we could work in Minnesota to raise the awareness of how important it is to preserve 1031, because the statistics show that it's not a very good pay for, that actually more economic vitality comes from the stimulus effect of 1031, and more revenues are actually collected by taxing authorities by keeping it in the code than the amount of revenue they would collect if they removed it from the code. And by the way, I don't think they would collect as much revenue because people just would be locked in. They would say, I'm not going to sell. I don't know a single farmer that would volunteer to sell their farm if they could not defer the gain. They will simply not give away a third of their hard-earned equity when it's not available.
Yeah, I would agree with that. Going back to your opportunity zone investment in urban downtowns, same scenario. You're foregoing collecting some tax on the front end, but
the stimulus effect is huge.
Yes, it would be very big.
I mean,
interesting to see if that has legs.
I look at little cute downtown areas like Rochester, which has retail, that has shops where people can actually buy things, and look at where we're at in Minneapolis. Is there any retail on Nicollet Mall? I don't think so. I think that beautiful jewelry store that was on 12th and Nicollet is long gone. There's no retail left in Minneapolis. That is an indication of some of the trends that are going on. That has to do with the Amazon effect and how consumers buy stuff. But it also has to do with social stuff and how people feel safe and whether or not they are comfortable coming downtown to shop, or whether they'd rather go to a shopping mall in a suburb.
Yeah.
So there's all kinds of societal things that are affecting downtowns, in particular the remote working thing. That's a huge, huge change.
Yeah, all fair points. Downtown Minneapolis, when it's vibrant, is a very beautiful place. Downtown St. Paul is as well, but it closes at everything. The city shuts down at 5 o'clock. It's much, much different.
I'm originally from St. Paul, and I think that the city leaders have failed St. Paul for 40 years. It is not vital. It is not fun. And it's not a pleasant place to go.
Yeah, I don't disagree. It'll be interesting to see what happens in both cities in the coming years. Yes. So again, loved chatting. Thank you. I learned a lot. Can you tell people how they can reach you?
Well, I'm happy if you want to send me an email at jeffp@cpec1031, or my phone number is 612-643-1031. That's 612-643-1031.
All right. Thanks, Jeff.
Thank you.
Have a great day.
Thanks, John. Bye now.
Yep.